we've bought distressed assets straight from the insolvency courts in Germany. We've bought from funds that need to sort of reduce their overall exposure. We've bought from developers that need cash flow that simply, the banking market has sort of not been available for them. And we bought from developers that needed to deleverage, where they had partial recourse obligations and banks wanted them to reduce their exposure, where they had sort of reputational recourse. We've done debt for equity swaps, so we've gone in and bought loans at a discount and then worked out a consensual arrangement with the pre-existing developer to pay them actually a significant amount of money for their equity in exchange for taking control of a project. We have bought straight REO from banks in Germany, where we've taken control of a piece of real estate and done some additional work. We bought also from private equity funds that are seeking to exit the market. We bought from private equity funds that had bought non-performing loans in the prior run-up, let's say 2004. So clearly if we're buying in 2011 and they were buying in 2004, that gives you a sense of how long it takes to work some of these things out. And I would say more interestingly has been a shift in the last year and a half where we're getting more involved on the financial side of things, where we're seeing an opportunity where it's now really apparent that the lending markets are not kicking back in any meaningful way. And I think that that's probably the biggest problem for our sort of types of groups, because recently we've been making some loans, and obviously it's on a very small scale and it's very opportunistic, so it is by no means an indicator of what should happen in the market or what could happen, because when you have a small fund making loans, it doesn't really move the needle. It's not even it's just not even a drop in the bucket. In addition, we've just bought another asset from a German insolvency proceeding, and that took close to 2 years to work out. So it's just very slow and tedious, even though it should be a fairly straightforward process. And then a recent deal we did was for a private equity fund where they had done a massive restructure of a large corporate entity, and they had assets that they couldn't get leverage on, and so we came and did basically a sale-leaseback transaction, which effectively is a form of financing. In the past, the way governments had stepped in and sort of recapitalized both Japan and Korea and certainly Thailand, taxpayers paid a fairly large price, but the effect was to sort of kickstart the system and get it rolling again. And you sort of haven't seen that same impetus. You've seen various operations, but it really doesn't solve the problem for the banks. I mean, the fact that they can now hold assets on their balance sheet at a cost of funds of zero doesn't really solve the problem. And we really haven't seen any progress towards good banks, bad bank solutions, or really some sort of wholesale liquidation. So, I think that continuing to solve it one by one is probably what's going to happen for the foreseeable future.